Hello, everyone. Good morning. My name is Yasir Gulfraz, and I am your tutor for today's session, which is Learning Outcome 2 for Financial Accounting 1, able to prepare and interpret a financial statement of cash flow. So, if anyone is there, can you see my screen clearly or can you hear my voice? If anyone is there and you can't hear me or can't see my screen, please do let me know. Anyone is there? Okay. So today we will discuss about financial accounting and focusing on an essential topic, which is statement of cash flow. This concept might sound a bit technical, but I'll break it down for you in some simple terms. So here is just some command of verbs: explain, to account of, the purpose of, reasons, analyze, review, and assess. This is command of verbs. Analyze means that this is basically for your assignment purpose. If they're asking for explain and analysis, review, or assess, so different meanings for different words. Anyway, indicative contents. So we will talk about statement of cash flow and explain the purpose of statement of cash flow. Prepare a statement of cash flow. Indirect methods: prepare the note to the statement of cash flow, reconciling operating profit to net cash flow from operating activities. Analyze and evaluate the significance of information within the statement of cash flows. So anyone is there? Okay. So cash flow, what is the cash flow? If anyone is there, can tell me what is the cash flow. A statement of cash flow is like a financial report that shows how much actual cash your business bought in and spent during a specific time, normally a year. It's a way to understand if your business is not only making profit but also managing its cash effectively. So also, why do we need statement of cash flow? Statement of cash flow are important for a few key reasons. Uh, First of all, it's a liquidity and survival. Making profit is great, but having enough cash on hand is crucial for the short-term survival of any business. You need cash to pay your immediate bills and debts. Adaptability: imagine if your lemonade stand suddenly faced unexpected, or your small business, any kind of small businesses face suddenly unexpected challenges. Could you adjust your operation quickly to handle these challenges? uh, the statement of cash flow help us assess a business ability to adapt to unforeseen events. Future planning: looking ahead, you might want to expand your business, to buy a bigger stand, a bigger business, bigger company. So to do that, you need to plan for the future by ensuring you have enough cash to invest. So next one is objective information. Unlike profit, which can be calculated using various methods, cash flow is a straightforward financial measures. It helps identify problems early on. So prepare a statement of cash flow from given data. A statement of cash flows summarize all movements of cash into and out of business during the accounting period. This provides users of the financial statement with information about an entity's ability to generate cash and cash equivalent. So definition: cash on hand or demand deposit normally includes current petty cash equivalents, short-term, highly liquid investment. There are readily convertible to known amount of cash and which are subject to an insignificant risk of changes in value. For example, deposit account investment that mature within 3 months of acquisition. Then third one is cash flows, inflows and outflows of cash and cash equivalences. So basically, think of cash as the actual physical money you can touch and hold. It's the currency you use to pay for things. For example, the bills, coins you use to buy or pay for your different kind of things, such as your morning coffee or lunch or considered cash. So cash equivalents are like the close friends of cash. These are short-term investment that are highly liquid and easily convertible into cash. They are so close to being cash that they are almost uh, you know, distinguishable. So then cash flows, imagine, a river flowing steadily. So that's how money moves in and out of business. Cash flows refer to the movement of money into and out of company over a specific period of time. Any question if anyone is there? Okay. So click to add title. Cash flows are grouped under headings: operating activities. Uh, IAS 7 allows use methods of presenting cash flows from operating activities, indirect methods and direct methods. So operating activities, we can put here operating activities, yeah. So these are the day-to-day money movement. Anybody can explain me if anyone is there can tell me about operating activities. Okay, so the principal revenue producing activities of the entity and other activities that are not investing or financing activities. So these are the day-to-day money movement related to company's core business operations. For example, if your companies receive cash from selling companies, that's a positive cash flow from operating activities. So investing activities, these involves buying or selling assets like equipment, property, or investments. If you decide to invest some of your some of your company's profit in a new business, that's cash flow from investing activities. So financing activities, this category covers transactions related to the company's capital structures, like borrowing money, repaying loan, or issuing share. If you borrow money to expand your uh, companies or any of your business, the cash you receive is a financing activity. Any questions so far, if anyone is there? Hello? Okay. Uh, yeah, cash flow, format of cash flow statement. So here we can add format, cash flow statement. So A cash flow statement typically starts with company's net income from the income statement, which use accrual accounting and then adjusts it for non-cash items and changes in working capital to arrive at the actual cash generated or used by the company. So the ultimate goal of a cash flow statement is to show whether the company is generating enough cash to cover its operating expenses, investments, and financing obligations. It's a tool for assessing a company's financial health and its ability to manage cash effectively. So format of, if you can see here, reconciliation of profit and operation to net cash from operating activities for the year ended. So profit before tax adjust meant for, finance cost, depreciation, dividend received, loss or deposit of or disposal of property, plant and equipment, increase or decrease in inventories, increase or decrease in trade and other receivables, decrease in trade payables, cash generation rated by operating, interest paid, tax paid, so net cash from operating activities. So there is a direct method shows that cash received from customers, cash payments to suppliers and employers, cash generate from operations, interest paid, tax paid, net cash from operating activities. Any questions so far, if anyone is there? So here is a cash of statement of financial positions or balance sheet. ACE Limited for the year ending 31st March 2023 with the statement of comprehensive income of the year. So statement of financial state position, you know that it shows current assets, current non-current assets, then current assets, total assets, then equity and liabilities come to the liability size, and non-current liabilities, current liabilities, and total liabilities. Statement of comprehensive income of the year ending 31st March 2023, operating profit, income from investments, loss or on sale of fixed asset, profit from operations, and finance costs, profit before taxes, tax profit for the year. During the year, property, plant, and equipment were sold, which had originally cost £52,000 and had a net book value of 31,000. So prepare a statement of cash flow for the year ended 31st March 2023. So here's our ledgers as well, tax, investments, non-current assets, provision of depreciation, disposal, cash, and cash equivalencies. Then reconciliation of profit and operating, the net cash flow from operating activities, profit from operations before tax, adjustments for depreciation of the year, investment income in inventions, in trade receivable, in trade payable, cash used in from operations, interest paid, account paid during the year, income taxes paid, note amount paid during the year, a net cash used in from operating activities. So again, cash flow statement, net cash flow activities, all purchases, process, interest received, dividend received, income received. Here, all the cash received from, different sources or sale of investments, purchases of investments, and then cash flow from financing activities, capital share, proceed from long-term borrowing, repayment and long-term borrowing, and dividend paid, net cash, so etc. A statement of cash flow for the year ended, net cash from operating activities, investing activities, purchase of property, plant, and equipment, proceed on disposal of property, plant, and equipment, interest received, dividend received, net cash used in investing activities, financing activities, proceed from issues of shared capital, increase in bank loans, dividend paid, net cash used in financing activities, net increase in cash and cash equivalences, cash and cash equivalences at beginning of year, cash and cash equivalent at the end of year. Uh, so this is all basically the format of cash flow statement. So interpret the cash flow. Has cash increased or decreased in the period? How material in the increase, decrease in the cash compared with the entity's cash balances? Does the cash entity have a position cash balance or an overdraft? Uh, Inventories receivable and payable increased or decreased? If these enough cash to cover interest, tax, dividends? If there has been capital expenditures, where has the cash comes from debt increasing or decreasing? Will it entity be able to pay its debt interests? Then will the entity be able to repay the debts if it falls due to the near future? Or is the entity likely to need additional long-term finance? Cash flow from operating activities, cash flow from investing activities, cash flow from financing activities, and net decrease, increase in cash and cash equivalences, reconciliation of net cash flow to movement in net debts in the period. So next, make justified recommendations based on a organization statement of cash flow, cash generated from operations, interest and taxes, investing activities, financing activities, cash and cash equivalencies. So when we talk about cash generated from operations, start with profit before tax. Then we add back finance cost in your assessment. Finance cost would always be same as interest paid. Uh, Add back depreciation, deduct dividend received, disposal of assets, back or loss, deduct again, deduct increase in inventories, add back increase in payables. So interest and taxes, if not accruals, interest changes, cash outflow in your assessment, this will always be the case, though not always in practice. Tax if expense, closing payable, cash outflows, opening payable, and investing activities, calculate purchase of PPE activities, operating balance, disposal or depreciation, etc. Financing activities, cash flow is normally the difference between opening and closing figures in statement of financial positions. Dividends usually give in task, otherwise reconstruct movement in relevant earnings. So cash and cash equivalents, net increase, decrease should equal difference between closing and operating figures in statement of financial positions. So the statement, the thing is to remember or keep in your mind that cash flow, statement of cash flow is not just a report. It is a roadmap that helps you guide a business towards better financial decisions. By analyzing the statements and making informed recommendations, you can help the organization navigate financial challenges seize opportunities, and ensures their long-term success. Any questions so far, if anyone is there? Okay, so the need for a statement of cash flow, profit and liquidity. The accounting concepts of accruals and matching are used to compute a profit figure which shows the additional wealth created for the owners of a business during an accounting period. However, it is important for a business to generate cash as well as to make profit. Uh, the two do not necessarily go hand in hand. The objective of IAS 7R ensures that companies report their cash generations and cash absorptions for a period by highlighting the significant component of cash flow in a way that facilitates comparison of the cash flow performance different businesses. So provide informations that assets assist in the assessment of their liquidity, solvency, and financial adaptability. A profit figure here is talking about that a profit figure is an additional wealth created for a business owners during an accounting period. Okay, so and it is calculated using the accounting concepts of accrual and matching. Cash flow is crucial to a company's success as profit. So these two are not always, intertwined. So IAS was created with the following goals. Number one, report cash inflows and outflows over a given time frame, drawing attention to the significant cash flows drives to allow for direct company comparisons. So they must provide the relevant information to help evaluate their financial flexibility, liquidity, and solvency. Any questions so far, if anyone is there? Everybody can hear me? Okay. Next one is the importance of statement of cash flow. Statement of cash flow are important statement for the users of accounts because they help users to assess liquidity and solvency. An adequate cash position is essential in the short term, both to ensure the survival of the business and to enable debts and dividends to be paid. Also, they help users to assess financial adaptability. Will the company be able to take effective actions to alter its cash flow in response to any unexpected events? They help users assess future cash flows and an adequate cash position in the long term is essential to enable assets replacement, repayment of debts, and fund further expansion. Then cash flow means survival. A company may be profitable, but if it does not have an adequate cash position, it may not be able to survive. They help to highlight where cash is being generated. The statement of cash flow will clearly detail cash that is being generated from the core activities of an business and other non-operating activities. Cash flows are objective. A cash flow is a matter of fact, whereas the conclusion calculation of profit is subjective. They help to indicate problems early. So users of as we discussed that uh, a profit figure is an additional wealth created for a business owners during an accounting period. So it's calculated using the accounting concepts of accrual and matching. So cash flow is a crucial for company success as a profit. So these two are not always intertwined. So here users of the accounting benefit significantly from the information provided by the statement of cash flows because it allows for a more accurate evaluation of the company's liquidity and solvency. In the short terms, an adequate cash position is essential for both the survival of the business and the payment of debts and dividends. They add consumers in determining their financial flexibility. Will the company's response time to unforeseen events allow it to either cash flow effectively? Uh, they help consumers evaluate prospective cash flows. Healthy cash positions over the long term is necessary for funding expansions, debt repayments, and asset replacement. So, any questions so far, if anyone is there? Okay. Evaluate the significance of information within a statement of cash flow. If anyone is there, uh, can you can ask any question if anyone is there? Any questions so far? Okay. Evaluate the significance of information within a statement of cash flows. Cash flow is a vital to the survival of a company, both in the long and the short term. To reflect this, one of the key measures of the health of a business is solvency or liquidity. In summary, management have various liquid assets at their disposal that they can use to settle their debts in the short term. These includes inventory, receivables, and cash. For example, current assets, they are used to pay off overdraft, trade payables, loans, interest, and tax balances. Current liabilities, tax balances, for example, current liabilities. So management should maintain sufficient current uh, assets to be able to pay their current liabilities as they fall due. So if they do not, they will default their payments, lose supplier goodwill, or suffer fines and sanctions. In the worst case scenario, a supplier, lender, or tax authority may even have a company put into administration or liquidation in an attempt to recover amount due to them. To ensure an effective balance, management must consider inventory, production, and storage cycles and have an effective system of credit control to ensure cash is received into the businesses as soon as possible. So on the flip side, they must allow manage the level of debts they expose the business to. Uh, a company's basically ability to bring in money is critical to its success, both now and in the future, because of the solvency or liquidity is one of the most critical indicators of a company's health. So here he's talking about management process, several liquid assets to pay outstanding debts immediately. Current assets consist of stock on hand, money on hand, and accounts receivable, overdraft fee, vendor payments, loan interest, tax liabilities are all examples of current liabilities that can be settled with cash. The company management should always have enough liquid assets to cover its short-term obligations. If they don't, they risk falling into payment default, uh, uh, alienating their suppliers, or facing other penalties measures. So a supplier, lender, or tax authority may even seek administrations, as he said, or liquidation of a company to recover any debts owed by company. Any questions so far, if anyone is there? Any question if anyone is there? Okay. So next one is evaluate the usefulness of a statement of cash flows to different organizations. There are some obviously advantages and there are some limitations. Advantages can alert user to liquidity problems, shows how well or badly profit is converted to cash. Uh, Obviously, cash is a matter of fact and not easily manipulated, not affected by accounting policies or estimates. Also can help users to predict future cash flows, easier to understand than profit for some users. Standard headings enables users to compare cash flows of different entities. So next is limitations. Cash balances can be manipulated, for example, by delaying payment to suppliers. It is possible to focus on cash flow at the expense of profit, for example, by not replacing plant and equipment. In the long term. A business needs both to survive. Historical information is not necessarily a reliable indicator of future cash flows. Any question if anyone is there? Okay, so next one, the difference between profit and cash. Anybody can tell me what is the difference between uh, cash or and profit? Whilst a business might be profitable, this does not mean that will be able to survive. To achieve this, they need cash to be able to pay their debts. If they could not pay their debts, they would be put into administration or liquidation. The main reason for this problem is that profit is not the same as cash flow. Profits from the income statements are calculated on the accrual basis. Most goods and services are sold on credit, so at the point of sale, revenue is recognized but not cash received. So it's basically a credit sale. So the same can be said of a credit purchase. There are also a number of examples that are recognized that have no cash impact. Depreciation is a good example of this. So a business can at the same time be profitable but have no cash uh, left to pay its supplier. For the reason it is important that users of the financial statement can assess the cash position of a business uh, at the end of the year, but also how cash has been used and generated by the business during the accounting period. So a company profitability is not necessarily indicative or its long-term viability. To accomplish this, they need money to pay off their debts. They would be forced into administration liquidation if they could not, meet their financial obligations. So that's why he's trying to say that the fact that profit and cash flows are two are different things is the primary cause of this issue. The income statement's bottom line is figured using an accrual basis. Revenue is recognized, but no cash is received at the point of a sale when most goods and services are sold on credit. So again, as I said, he's talking about a credit sale. So it is the same way the buying things on credit, like for example, credit purchases, and also as he said, depreciation is the one example of recognized expenses that does not result in spending cash outlay. So a company can make money but still be unable to pay its bills. So that's it for today. For example of cash flows, here you can visit this website, and here are some references. If you want to check, you can go one by one, like ACCA websites or uh, KF Knowledge Bank, Kaplan websites. So you can get some data from different books about cash flow. That's it for today, guys. If any question, if anyone is there, if there is any question. Okay, so if you have any questions or any issues, please drop me an email at yasir at ukversity .co.uk, and this was our learning outcome too, and hopefully I'll see you next weekend for our next session, and by then bye now. Bye for today. Bye for now, and I'll see you next weekend. Thank you very much.